Corporate finance practice problem using Excel. Stock dividend and cash dividend impact on equity section. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side. We're focusing in on the equity section and the impact of both stock dividends and cash dividends on it. Remember that the effect of stock dividends and cash dividends will generally be in the equity section. So when you picture, in essence, the balance sheet, assets, liabilities, and equity, the equity represents the owner's claim to the assets, or you can also think of the equation as assets minus liabilities equaling equity. Equity then, in essence, being the book value of the company. You can think about the equity in aggregate, in total, meaning the total basically value that the owners have claim over basically the assets as opposed to the debtors. And then, of course, we can break that out into the units for a corporation, those being kind of standardized unit type of calculations. That's why we have the standardized units of ownership of the stock. So equity section starting point, we're going to have the stock at the shares, 15,000 shares. The par value is 5. That gives us the common stock that has been issued 15,000 times the 5 of the 75,000. Capital in excess of par at the 40,000. So what that means, remember, is that the common stock and the represents the amount of stock that has been issued out from the company into the public. The par value is basically a made-up number, usually wanting to be less than the market price. That'll give us a nice even common stock amount, allowing us to go back and forth easily between the common stock and the number of shares that are outstanding. The capital in excess of par is the money that we're going to be getting over and above the par value. So it represents, these two numbers represent the amount of money that we got basically from the investors as the company issued the stock onto the market. As the company issues the stock, of course, they will fluctuate the price to whatever the market price is, getting whatever the price will be. The par value keeps it kind of more stable. So you can see that nice relationship between the common stock and the shares, and all the excess goes into the capital in excess of par. Retained earnings then represents the earnings of the company that have accumulated through generation of revenue over the lifetime that has not yet been distributed in the form of dividends. Normally, if you pay cash dividends, they would come out of retained earnings, as we'll see. So now we have the stock market price, we're saying is $7 for the purposes of our calculation. The stock dividend, 5%, cash dividend, then after the stock dividend, because we'll have more shares out there, will be the 10 cents per share. So we're going to start off, let's kind of rework this and first think about the stock dividend. What's the impact? If we think about then the equity section, let's go ahead and just rework the equity section. I'm going to populate it here, and that'll be kind of our starting point, and then we'll make adjustments to it. So I'm just going to say this equals this item. I'm going to copy that down. I'm going to grab it, autofill that on down, picking up the same items, and then I'm going to do my indentations. I'll do these three. Alignment, indent. I'm going to indent this one as well. Let's indent that one. And then we'll go down, and that looks pretty good. And then I'll pick up the same numbers for the starting point, and then we're going to go ahead and adjust them. So I'm going to bring those over. I'm going to do the same calculations so that when I do my adjustments, they should be done automatically. So the common stock is going to be the 15,000 times the 5. In other words, we'll pick up the capital in excess of par as the starting point, the retained earnings at the starting point, underline that, font group and underline, and then let's sum up the total. And once again, once we do a change to it, the sum should change along with our adjustments. So we're going to have to do adjustments for some of these, and we'll think about what that will look like. First, let's take a look at the number of new shares that are going to be out there with this 5% stock dividend. So the current shares, so shares, or the original shares, let's say the beginning shares are going to be equal to, and I'm pulling not from the blue item, but over here because we're going to change the equity section in blue. So I'm going to be picking up the number of shares here, which is going to be the 15,000 shares. Then we have the stock dividend. So the stock dividend percent is going to be the 5%. So we're going to be picking up the 5% on down below as we're told to do, making that a percent by going to the number group, percentifying it font group and underlining it, that's going to give us our new shares, which is going to be equal to the 15,000 times the 5% or the 750 new shares. Now let's think about what the common stock will be after the stock dividends. How much are we going to have or what's the total in the common stock after the stock dividends? So let's pick up our beginning shares again. Beginning shares were that 15,000. We're going to add the new shares to it. The new shares we're going to say are 750 that are going to be going out from the stock dividend. So if we go to the font and underline, that's going to give us our common stock shares that are outstanding after the stock dividends. Summing this up equals the SUM of 15 and the 750. That's going to give us our 15,750. Then we have the par value to get to the actual amount. So this would be the number of shares. Par value is that arbitrary $5. It's not going to change in this case because it's kind of that arbitrary basically number that should be a nice kind of even number or easy number in essence to work with. And so we're going to then go to the font group and underline, and that's going to give us our total. I'll just call it the total down here. This will be equal to the 15,750 times the 5. So that's what's going to go here. So we're going to say the 15 we expect to go to change to 15,750, and then this number is going to change to that 78750. But let's not do that yet. Not yet. Hold on. Just be patient. Be patient. So now we're going to do the capital in excess of par calculation. So that's going to be, we're looking at this number, which is going to be adjusted. So we're going to be saying, all right, that's going to be the new shares. The new shares is going to be equal to, let's pick it up here, the 750. And then we have the stock market price. So market price coming into play at the $7. $7 on the market price. Now, $5 was the par value. So they're pretty close here. And the $5 was the par value. So we're going to take the difference between those two to adjust the capital in excess of par, because remember, we have to split up in essence the value between these two things, the common stock and the capital in excess of par, if we have a company that has par value. So we're going to go to the font group and underline that, and this is, I'll just call it the difference, and that's going to be equal to the 7 minus the 5. And so then we're going to say this will be, I'll call it the change. So the change is going to be equal to the 750 times the $2. Let's put an underline there, font group and underline. And then I'm going to add that to the starting balance, which we had in the excess in capital in excess of par. We don't want to pick up this one because we're going to change that. Pick it up from over here, the beginning numbers, the 40,000. And so there we have that. I'm going to underline it by going to the font group and underline. And this is going to be the capital in excess of par, which is going to then be equal to the sum of these two. So I'm going to recap this again. So hopefully this will make more sense once we do the recap. But that's going to be here. And now let's think about the next item, which, let's roll it back up on top, is going to be the retained earnings. So let's pick the retained earnings now, the adjustment up for that. We're going to say the starting balance is going to be the 180. I think we started at 180. And I'm going to pull it up from over here. Again, don't pick it up from the blue number. Pick it up from the original number, the 180. So we want the 180. We're going to be issuing the new shares. The number of shares is going to be, we said 750 right there, 750 new shares at the stock price. Let's say market price, which is going to be equal to, we said $7, I believe, $7. So let's underline that, font group and underline. And that's going to give us the value of new shares, which is going to put that to the outside. That's going to be the 750 times the 7, or the 5,250, to give us the ending retained earnings, which is going to be equal to, let's do the 180,000 minus the 5,250. underlining the 5250 by going to the font group and underline. So there we have it. Now here you can kind of see, just as a recap, what's happening here. We've got the shares that are going out. We're going to give a value not in dollars, but in shares. This is the market price. These are the new shares that are going out. Therefore, we're going to have an adjustment to retained earnings in a similar way that we would if cash was going out for the value of what we're giving out. So that means retained earnings, just like with a cash dividend, is going down. We're reducing the earnings that have been retained because we're giving value back, not in the form of cash, but in the form of this stock dividend. So we can see then this number is going to go down, the retained earnings. We can even look at this at this point in time and then adjust it again for the cash dividend possibly. So we can see here, this is going to be the retained earnings of this number. So it went down, and then we're not going to adjust assets or liabilities. So clearly something else has to adjust in the equity section to get these two numbers to basically reconcile. So the other two things that are going to be adjusted is we had the shares, the number of shares have changed up top. So the number of shares are now at the 5,750 because we added another 750 to it. We could see that 5 of the $7 has been accounted for here due to the fact that the par value is $5. So that means that's why the capital in excess of par calculation took care of the difference, the other $2 on that 750 change that needed to take place to get us that 41,500. So this is going to be equal to that 41,500. And you can see that gets us back to the same spot. So we're at the same spot after the stock dividend. Let's go ahead and try to copy this down. Let's copy this down and think about where we would then be after the cash dividend. So let's say equity section. This should already be there for you after cash dividend. So we'll adjust that. And let's just copy this whole thing again. I'm just going to delete this and just bring the same stuff down. And let's just copy this time. Nah, let's do it the same way. Oh, now I made it. Something funny happened there. This equals the common stock. Let's go ahead and drag that on down, dragging that on down. And so there we have that. Let's format it a little bit. Let's take these three and indent them. Alignment, indent. Let's indent this one again. Let's pick up our numbers, this is going to be equal to the 15,750. This is going to be equal to the 5. Multiplying that out, 15,750 times the 5. Capital in excess of par, 41.5. The retained earnings will be at the 174,750. And then summing this up equals the SUM. We have our same numbers. Now we'll just adjust this for the cash dividend, which should be a straightforward type of thing, decreasing the retained earnings. And the other side there would go to an asset account, being cashed, would be the other side, decreasing the cash dividend. All right, let's do that. We're going to calculate the retained earnings after the cash dividend. So we have the starting balance. The starting balance for the retained earnings, we're going to say, is here. And now we're going to do the cash dividend part after we did the stock dividend, now that more stocks are out there now. So we're going to say, all right, we have a the dividend per share is going to be, we said, equal to 10 cents. 10 cents. Let's make that a decimal number group, adding a couple decimals. And then we have these shares. The shares now, after we have added the new shares, is going to be the 15,750. Let's pick it up right there. Let's go and underline that, font group and underline. So 10 cents for the new shares. So we have the total dividends, which is going to be equal to the 10 cents times the 15,750 for the 1,575 to give us our new retained earnings after, but I'll just keep it there. New retained earnings is going to be then equal to the 174,750 minus the dividends that were given out, because they're no longer retained after we give them out. Now they're not retained anymore. And so we're at the 173, 175. So 173, 175. So let's put that in our second section. That's what this new retained earnings will be. That's our ending balance here. The difference between these two retained earnings then, between what we had before and this retained earnings, is going to be the cash dividend that went out. The amount of cash dividend that went out here, because the other side of that went to the difference. The other side of that went to the cash. And you can also do that here. You could say, okay, well, the same difference would be here, that from our starting point minus this one, same item, because these two are the same. The stock dividend only impacted the equity section. The normal dividend, of course, affected cash as well. So I could put a difference here, and let's go ahead and just make those blue. So you can check those out if you so choose. Put a little brackets around it too. There we go. Looks great.